Thank you, and good morning. I'm delighted to see some sunshine. I hope you all are enjoying this moment. It's a pleasure to be back in Oslo. I was here 2 years ago, and I thank Skagen for the invitation to be with you this morning, and particularly to talk about one of my favorite subjects, and I'll also be talking about my second favorite subject, by the way, which is gender equality, as part of my remarks, and to be part of your conference, which is looking ahead, but with some important looks back. And the title of my talk, How to Beat the Market with Responsible Investments. I'm not going to be promising you some stock tips that will take you into the next decade, but I will be going through some trends and some things to keep an eye on in terms of ESG. And it is probably useful to start with my own journey in ESG, and then talk about this indeed powerful trend for very good reasons. A bit of commentary on big data as a new driver or technology, if we want to call it that, AI, of investment performance, and then a moment on gender balance as a premium in a corporate setting and in an investment discipline. It's a premium, not a penalty. I have been in asset management for 40 years. The first 23 of those years were with Alliance Capital Management in New York, a very, I would say, conventional asset management firm. I have degrees in mathematics. And importantly, I moved through the ranks at Alliance and was approached in 1997 for a CEO position in the mutual fund industry. And women, frankly, were not often approached for this. And I flew to Washington for the interview and seriously considered joining Calvert Investments. And Calvert at the time was the leading SRI firm. We used to call it SRI, Socially Responsible Investing. I didn't know much about SRI, but I knew a lot about growth equities and equity investing. And I invested some time learning what the ESG analytical approach was all about, and spent time with the analysts at Calvert before making a decision. And what I believed was that it was very important to be evaluating cash flows, growth, financial performance of a company. But I also believed, with my colleagues at the time, that quality of management mattered a lot in how a company would perform. But when I probed my colleagues about what is quality of management at Alliance Capital in the conventional world, I was never satisfied with the answer. It was always the financial performance delivered by a particular management team, by a particular strategy. And I said, well, we're already considering that. So what else is in quality of management? I really felt ESG provided the answer, and Calvert provided the answer. Quality of management, what all active managers look for, what all of us look for as investors, but we can't tell how it's produced. Perhaps it's produced by management teams and corporate strategies that both can achieve short-term gains. And very honestly, we haven't touched on this, but the world has gotten much shorter in terms of its patience with delivering returns. We certainly have very active trading strategies delivering returns. But a long-term strategy for a corporation is often now 3 years or 5 years at most. But so many good ideas, so many trends, so many important factors, so many risk factors extend way beyond 5 years and yet have material impact on that corporation. Many of us as investors, investing for retirement, investing for longer-term goals, we have outlooks much longer than 5 years. So perhaps ESG is that elusive quality of management that concurrently management teams can achieve both short-term goals and long-term goals. On that basis, I joined Calvert in 1997, believing there should be no give up in investment returns because one is following ESG principles in stock selection. And so I set a bar that we would strive to achieve competitive returns incorporating ESG analysis in our stock selection. Possibly the patterns of return would be different, but overall, no give up. When I joined Calvert, it was sufficiently, I guess, important or exciting at the time that the Washington Post covered my hiring. And instead of saying I was the first woman to lead Calvert, the headline was Wall Street Veteran to Lead SRI Firm. And I think that at the time, I certainly didn't think of myself as a pioneer in any sense, but to me, that really turned a corner, and that was over 20 years ago in terms of my professional path. A bit about my personal path, which I'm going to weave in here, is that my personal philosophy, similar to the notion of concurrency in achieving ESG goals and financial goals simultaneously, I do think a journey in a career can concurrently incorporate really any lifestyle, any life that someone would like to achieve, whether that's having children. I have two daughters, a family, a rich life, as well as a rich career. And I found that something that would help had guided me to that point, was to not look at a career as a ladder, as a moving up, but as an obstacle course. And every obstacle can be tackled. Sometimes they're true obstacles, so you have to go around them. Sometimes that may mean leaving a job or making a transition of some sort. But viewing that it's an obstacle course and a ladder allows you to function in a career in a very collegial way, because many people can be on an obstacle course at the same time and succeed. There isn't one notion of proceeding where you have to knock off someone ahead of you to move forward. So as a CEO, and certainly in my own personal life, I've tried to follow a career path, a personal path that views life and views the workplace in this way. And I found certainly encouragement from the young people I talk to who are looking for more than just a ladder procession. They are looking for a world that is a better world to live in, an environment that's more supportive of who they are, that individuals do not want to check their identity at the door when they enter their workplace. They want to be the person who they are. So that I served as CEO for 17 years. It can at times feel like it was 17 days. It was a very exciting period of time during which a lot was happening in the world and in the investment sphere. You heard the introduction mention that this last decade has been phenomenal in terms of the trend of ESG. And I think this chart displays that, where you see the growth really from 2007 has been almost astronomical. It's certainly a trend that Knut mentioned. By the way, I don't speak Norwegian. I have no idea what Knut was saying. I do know what the slide said, but I hope I'm in sync with his view of ESG trends. So if we look at the left of this chart in 1997, that is when I started my tenure at Calvert. So clearly I was not joining Calvert because we had a lot of assets under management and it was a large firm. In fact, I had been responsible for $17 billion in assets and moved to a firm that had $4 billion. But I did believe the future growth in this area would exceed the growth in traditional asset management. But there were some obstacles to overcome, which I saw as soon as I arrived. One was investment performance. That to that point, a lot of investment firms in this space were less concerned about investment performance. They focused more on the ESG, which is, I think, fine for a value-based investor that would want to put a premium on simply the values that they were investing in. But I also believed it was possible to have both the values and the performance. Second, ESG was not that available. There weren't that many asset managers offering it. And I found in particular in the United States, there were impediments to offering ESG in retirement plans. The dominant retirement system in the United States is the 401k plan. I'm not sure there's quite an equivalent. That 401k refers to an IRS code section that allows individuals to save personally for retirement in a tax-favored manner. And at that point, Calvert had virtually zero in retirement assets. And there was a Department of Labor, a government impediment, because the definition of offering funds in these retirement plans stressed that you could only look at financial return. So one of the impediments we had to overcome to grow the company, and we did quadruple the company over the next decade, was one of the impediments was getting to the Department of Labor, and there happened to be a favorable administration in the 90s for having conversations with the Secretary of Labor about this impediment, and we were able to have a letter issued, which was called the Calvert Letter, that said you could add ESG funds to a 401k plan if you focused on the investment returns as well as the investment policies in the fund. So access helped, and over my tenure, we grew to 40% of our assets in 401k plans once we had that impediment removed. And the third stumbling block, I think, was communication. I think public awareness of what this meant to do ESG, that has grown astronomically. We saw, I think Knut was saying that there were several drivers of the ESG change, and he had societal up there. But I would also say if societal incorporated individual, and you'll have to tell me if he said that, because the individual drivers, the awareness of climate change, the awareness of the value of diversity and human rights issues in companies, and the corrosion of corruption, these are all also individuals who are really demanding of their asset managers and investment advisors that they take these factors into consideration. So with some impediments removed and some focus on education, things grew slowly for ESG until 2007. And we've heard a bit both from Dr. Doom in the morning and more recently about the Great Recession in 2008, 2009. And in that period, the ESG funds held up extremely well in that period. Calvert did not experience the drawdown that was experienced in conventional funds. And there was something about our ESG strategy that allowed us to prevail. In a somewhat similar way, the community banks in the US did very well through the recession, whereas the large banks did quite poorly. And of course, as you know, some failed and significant mergers took place. There was an increased focus on governance post-crisis, which of course the ESG funds, the G is governance, the ESG funds were always focusing on, and the climate change imperative surfaced dramatically. During the decade of really the early 2000s to the late 2000s, the emergence of codes of conduct, principles for responsible investment, which your firms are involved in and signatories to, principles for responsible insurance, which Storebrand is involved, is a signator to. So we did see through that decade significant growth in the ESG assets under management, and I have no reason to believe that trend will not continue. We certainly, by seeing some very large firms, Vanguard and BlackRock, their CEOs proclaiming that they have, and this is only within the last 3 years, that they now believe it's important to vote their proxies in a responsible way. This is taken as great big news because these are trillion-dollar managers. But this is something that many managers, and certainly Calvert, had been doing for decades. But it's now an awareness level that has really hit new heights. So why should ESG deliver you? Why should responsible investing deliver greater performance? And I'll talk a little bit of theory here about why an ESG profile should return more. And risk management is a significant umbrella term, but frankly, it comes down to, I think, three factors that are worth noting. A more competitive company will ultimately be able to deliver higher profitability and higher dividends. And can't companies be more competitive if they are tapping a larger talent pool and tapping a broader and deeper, longer-term thinking, short-term thinking talent pool? And certainly, ESG stock selection involves a focus on diverse teams, diverse boards, and really very leadership that could be capable of delivering this higher profitability. Secondly, on a very real level, better risk management. In a practical sense, ESG looks very carefully at health and safety practices in companies. Lower risk of severe incidents, and therefore lower tail risk. Tail risk is real. We saw it with BP, with the Deepwater Horizon. Very honestly, we saw it this past 2 weeks in Nissan Renault. Tail risk with executive compensation issues and perhaps corruption issues. That stocks can be severely hurt by a tail risk, an event risk. And ESG, in a theoretical way, can help perhaps be a warning about tail risk. And thirdly, low systematic risk should lead to lower cost of capital and therefore a higher valuation. Systematic risk would be an example of the Great Recession, that factors that affect everything will be perhaps affected less with an ESG strategy. Well, that's the theory. What about on a practical level? On a practical level, ESG is complicated. We have heard some of the areas of focus for ESG within the environment, very importantly, measuring carbon emissions, climate change risks, energy usage, water management, to name just four of many, many areas that can be focused on. Within the S, the social area, we have diversity issues, health and safety, human rights, responsible marketing. And again, these lists are not even comprehensive. And thirdly, within governance, board structure, bribery and corruption, executive compensation, and transparency, just four of the factors. There are challenges to asset managers to implement ESG strategies in light of this complexity of issues, the terminology, and really the assuring that an ESG management team has sustainability teams of analysts and data specialists, increasingly data specialists, to fully execute on stated ESG objectives. And when Tim mentions building up analyst staffs, I brighten up because I think that is a key in your asset management firm to really be assured that while productivity is very important, analysts in this space are very important because the issues are deep, and I would argue it's not enough to simply pick one. Back when SRI was the phraseology that was used, what we would call screening was the dominant methodology, avoiding a tobacco company, avoiding egregious polluters. It was screening. Now it's more forward-looking. Where are the opportunities going to come from? The companies who are improving their profile, the companies who have upside from these various factors, who will benefit from a focus on ESG. A phrase that you've heard, I think, in every speaker, perhaps not from Dr. Doom, but is the word greenwashing. That's another risk on a practical level, that it's become perhaps a little easier to say, we do look at these things. But I would argue one needs to look at who's doing the analysis and also the actual results of that. Again, we heard some important updates on voting proxies, on having dialogues with managements, and the firms, I mentioned two of them that made some very significant pronouncements that they were going to be very actively voting their proxies. The most recent data shows that they've actually voted virtually 100% of the time with management, close to 100% of the time. So is it actually happening? It's very important. Greenwashing is something to be concerned about. In the in the United States, the SEC just announced that they are actually going to be doing a study of firms that purport to have ESG guidelines, and they're going to see are they actually implementing these guidelines as they suggest they have. So performance, of course, cannot be guaranteed, but there is evidence to suggest that there is outperformance with ESG strategies, and it can and hopefully should occur. Morningstar did a study in 41 of 56 of their ESG indexes, that's 73%. Those indexes outperformed their non-ESG peers. Second piece of evidence is this bar chart. Illustrates 6 examples of fund groups that offer identical broad objectives, let's say large cap global growth, but they offer an ESG alternative and a non-ESG alternative. And what we have seen is that in otherwise similar policies, 5 of the 6 fund offerings offering ESG outperformed the non-ESG peer within that fund family. A third piece of evidence, which not on this chart, is Arabesque Asset Management, on whose board I serve, and Oxford University did a meta-study, which is a study of studies, of 200 research studies over the last decade that looked at ESG factors relative to performance of companies. And they showed a correlation between sustainable business practices and economic performance in 80% of the reviewed studies. The concluding comment of that study: prudent sustainability practices have a positive influence on investment performance. Looking at the company level, and a data tool called S-Ray, which Arabesque offers, includes ESG scores for 7,000 companies. And over the last 12 years, the top 20% of companies by ESG score in this analysis outperformed the bottom 20% by 3.4% annually, which compounded over 10 years is quite significant. So big data allows us to do these kinds of analyses. If we did not have the tools, the engines to analyze the data streams, there's a lot more data available to ESG managers. Companies are producing, maybe not enough yet, but are producing a lot more data. When I started out, we had to have a sea of analysts that were really, literally reading corporate reports and digging to find data. Now there are many data providers that can actually support the asset management process with significant data. And there is a new accounting initiative called the Sustainability Accounting Standards Board, which sounds a lot like the Financial Accounting Standards Board, deliberately, which produces guidelines for companies reporting their data according to the materiality of that data to that company. With all due respect to ExxonMobil, the most important data they could provide would be in the area of their risks of concentration in extractive oil and gas. And frankly, their diversity policies are important, but they're not as material to an ESG investor as knowing more about their environmental footprint. So it's not the same data that you look at for every company. You look at the data that is material to your overall ESG framework. The S in ESG includes a lot of different areas, as I've mentioned, very important areas. It does include gender equality. And frankly, one of the areas that attracted me in coming into the ESG space was been my commitment over decades to areas of women's leadership and to removing impediments to gender equality in the workplace. It's been a personal passion, which in the past I was only able to follow personally by joining women's organizations, being on the board of the Women's Campaign Fund in the US, the Women's Economic Roundtable. This is going back over 20 years. And to see that I could have an impact both also in my work was very exciting to me. It was an intersection of some personal values as well as professional challenges and goals. But what I saw when I got to Calvert in terms of how do we look at gender in the workplace, it was counting women on the board, counting women in senior management, and that's important. But my personal experience, and I believe my experience as a CEO as well, said that counting is not enough. What matters is culture. I also saw culture on one of the slides, so I will have to learn a little bit more about what is meant by culture by the other speakers. But culture is the workplace practices, the norms, which are sometimes unrecognized, what is valued, what is compensated for, what is measured, and culture is also very important. Understanding this at Calvert, our analysts came up with an approach that said we could help develop almost a checklist of areas of focus for companies in terms of creating a workplace that is truly gender neutral. And we developed the Calvert Women's Principles, 7 areas that included the role of leadership, pay equity, health, safety, well-being, education, training, supply chain management, community initiatives, and transparency. And we worked in conjunction with the United Nations, with UN Women. When we launched the principles in 2004, we certainly were public about coming out with these principles and launching them at the UN. We were approached, it's hard to believe actually, but we were approached by companies, including Starbucks, Dell, and Pfizer, who wanted to be at the launch of these principles in 2004. So we invited them to be there and to speak about the need for these guidelines. It was almost like there was a hunger for an approach that would help companies be able to look at their workplaces in a gender neutral way. But Calvert is not a public policy company, and what we found was I had hoped that these guidelines would become pretty much something that could be measured and tracked and publicized. But what we found was, while they were well received, they weren't being used in any real way. And so in 2011, we donated the principles to the United Nations. Donated. I think the lawyers would say we sold it for $1 to the United Nations, who didn't donate it. And they became the Women's Empowerment Principles of the United Nations, which is a signatory process similar to the Global Compact, where companies sign on to the women's principles. And I'm pleased that I believe it's over 10,000 companies have signed on around the world to the women's principles. And it's useful at this point to comment on Norway's positioning in the world with respect to gender, and it is outstanding. Certainly when Norway was the first nation to address women's leadership at the board level with quotas, it met with a lot of skepticism, maybe even within the country, but around the world. I was applauding, by the way, but it might have met with some skepticism. But it has proven to be really the flagship and the leading initiative. The US continues to lag significantly. It's a voluntary system. We've tried everything. And I don't think in our society a quota is necessarily going to work, but I'm a bit of a champion of them because I've seen them work. And on the flight over to Norway, I was reviewing the World Economic Forum report, their Gender Gap Study 2020, which they've just released in advance of the conference that's coming up. And Norway ranked number 2 in their gender equality index, behind Iceland. And 3 and 4 were Finland and Sweden. So the Nordics have shown very, very well in this. Their measures are broader than an economic measure. They do have economic participation and opportunity, but very importantly, educational attainment, health and safety, and political empowerment. So I think there's quite a lot to be pleased with. I know we all can find some area that we feel needs improvement, but to have that kind of ranking on the world stage, I think is very exciting and really stands you very tall within the global community. Well, I think I touched on the women's empowerment principles that provide a roadmap for assessing corporate culture. But I'd also say this is really hard to do, to assess corporate culture. I chaired a task force on one of the boards I'm on, an energy company, to look at corporate culture, because the National Association of Corporate Directors in the US has really put front and center the notion that boards have a role in, we certainly don't want to get our hands within the operations, within management's purview, but there needs to be a focus at the board level on corporate culture. And found that there really is a lot that needs to be unpacked within a company culture in order to get at how is this truly a workplace that has a level playing field? We did find a number of recommendations to make to the energy company that would enable them to perhaps have a better track record with respect to gender. And that set of recommendations is being implemented. I'll touch on that in just a minute. But I do want to say there is evidence that gender balance is a premium, not a penalty. Specifically on the gender balance area, the Peterson Institute of Economics with Ernst & Young did a study, is gender diversity profitable? And they found a correlation between the greater number of female leaders and firm probability. And again, this is a counting exercise, but even just doing that, they did find that there was a stock price premium when there was a greater percentage of female leadership. And I would say you have that within the organization that you're invested with, a very strong record on board presence and executive presence. The issue really is that we need more women to be reaching the middle ranks and the upper ranks. I've given talks on a topic I call the messy middle, which is the mid-career challenges for women. And the fact that many of the programs designed to keep women in the workplace are not necessarily successful. In fact, one of the findings in the Peterson Institute study was that paternity leave, not maternity leave, is correlated with increased female leadership. So the offering of the benefit to the family and the encouragement of paternity leave is actually more important than giving women more time off, which then raises issues about coming back into the workplace following having children. So how can boards oversee corporate culture? And this chart, frankly, I think tells an interesting story. It's very hard to read, but I'll summarize it. It's from Marsh and McLennan, and it looks at the financial services industry, which is special in a way. Half of the workforce, half of the hiring in a financial services company is typically women. But yet, when you reach the top ranks, in the US at least, there are no women leading major banks in the United States. And it is true that this is truly a pyramid for gender diversity in terms of equal numbers of women coming in versus a very small number reaching the upper ranks. And this is what's called an internal labor map, where you look at new hires, you look at promotions, and then you look at exits. And while hiring is occurring at the lowest level in particular in a very equal way, promotions are not, and that's off by 1% or 2%. But to me, the most interesting statistic is the exits, that women are leaving at a slightly higher percentage in the middle to upper ranks. We're looking at 11 to 10%, 11 to 8%, 10 to 8%. So you say, well, that's not so bad. That actually sounds pretty equal. But remember, these are careers. I mean, a person stays in a professional career for years. And the compounding of even 1 or 2% over a number of years brings you to a very low representation of women at the very top of corporations. So of all the findings that we presented in our corporate culture study to our fellow board members and to management, I think the one that got the most attention was developing this chart by gender, because many firms will quote their statistics in an aggregate way, and it masks issues, and in particular the attrition number, and suggesting that the way companies learn about their culture could be through conducting, in the US we do what are called exit interviews. I did many exit interviews over the years at Calvert, 17 years. They tell you nothing, basically, because when people are leaving, they're not going to say negative things to the company. Or they're either going to say positive things or going to say really negative things and burn their bridges. But, and we saw an example of that too, didn't we, this past week in the press conference of the former head of Renault and Nissan, that you really can say negative things about the company, but most of the time people are saying positive things. They want to be able to use references. They want to be able to keep a good reputation in their industry. So what we recommended is that the firm move to using an outside party to do interviews in a group, in individual interviews, but over a period of time, and therefore give feedback that is not individualized, but it is more aggregated. And if that attrition number can change and can be the exits, the individuals that voluntarily leave. And here we're looking at voluntary exits, not those that occur because of reorganizations or of downsizing. None of this data is disclosed publicly. And I'd like to think if I had that data, that would be an investable premise for me. Who is holding on to their talented workforce across gender, across levels in the company? My last comments on the gender in the workplace have to do with a report that we put on our website. I'm affiliated with Georgetown University in the Women's Leadership Institute, where I'm a fellow, and this is a Pew Research study, which we thought was very relevant, that basically said the two things that were most important to move women forward in organizations are to deal with certain norms in companies. One, women are held to higher standards, and two, not ready to hire or elect women leaders. There was actually a debate in the United States last night by the Democratic candidates, and two of them, a woman and a man, were arguing that did one of them say that a woman could not be president of the United States. So that is going on, but those are the two most important factors. And interestingly, things like family responsibilities, women don't have as many connections, women are not tough enough, women don't make good managers, those are not considered to be impediments. So part of my message is that yes, it's important for women to work on their own leadership qualities and their own personal attributes, but the corporate attributes, the societal norms, those are more important. And the extent to which the responsible investment community and the ESG focus can help remove those barriers, I think we will unleash not just corporate performance, but the opportunity for all, for a gender-neutral workplace where everyone has an opportunity to excel and advance. So thank you for your time, and thank you for the opportunity to speak with you.
Great.
Okay.
Thank you so much, Barbara. That was really
Thank
interesting. Should you have any questions for her, please write them down and pass them on to one of my colleagues. I have a few questions for you. You started talking about quality of management and how hard it is to sort of decide or even sort of value quality of management. What would you say are the biggest challenges or problems today?
Well, I'd say in some ways, transparency has become more important to corporations, and investors are asking for more information. I'll give you one example of where this is an issue. Quality of management has to do also with, are you suffering lawsuits in the company? Are you suffering legal issues that you're settling and perhaps not bringing forward? And that's a way to judge, well, is management paying attention to the things? Certainly lawsuits that are trivial, one understands at times, particularly in the US where there's a litigious society, that those would be settled. But significant settlements do not get published or reported. So again, where I serve as a board member, one of our audit and finance recommendations was that management report all settlements to the board. No details, we don't need the details, but it's the volume. Is management anticipating issues and addressing them before they reach the level of litigation, whether it's public litigation or private individual litigation?
Mm-hmm. It seems to me, anyway, that investors are flocking to ESG investments at a great pace these days. Are there really enough projects for all this money flocking to this field? Or are we running a danger of having a green bubble?
I think that's a great question. I did not speak today about something called impact investing, which is more in line with projects that would have a great effect in terms of environmental change and improvement, and also sort of poverty alleviation, societal changes. There it strikes me we might see a bubble. But when it comes to large multinationals or even mid-size and small companies, I see no shortage of opportunity to reward companies that are improving their ESG profile and moving forward. I don't see ESG as being a bubble, but it's a very good question, because we heard a little bit this morning about there's frothiness somewhere. If we all knew where the frothiness was, obviously we would we would short those quadrants, but those sectors. But we don't know where that frothiness is going to come from. Certainly, debt levels have built up, and I think ESG that looks at responsible governance and credit postures that are responsibly developed, I think helps. I think governance, the G in governance, helps ESG avoid bubbles.
Okay, that's a good piece of advice then. So have a close look at that. Finally, you started quite some time ago. I'm not going to.
Yeah, a long time ago.
A long time ago, yeah. What made you so interested in sustainability issues? You must have come quite early to that party.
Well, honestly, I didn't feel early at the time, because at the time I got involved, there were funds that were in existence for 20 years. Calvert was in existence for 20 years when I arrived. But all those early funds were really started by individuals that came out of particular movements, whether it was environmental movement or peace, certainly PACs, funds. And Calvert, in a way, was very attractive to me because of their heritage. Calvert was the first mutual fund before my time in 1982 that would not invest in companies that did business in South Africa. So it was the first fund that did that. So when I joined, really I felt like I'm treading on other people's turf in terms of the values and the value that I embraced, obviously, with gender equality, and as the mother of 2 daughters, I was very keen on the notion that diversity was an important focus for investments. But it was in line with my general values that certainly the way a company operates, companies are players in our world. They can have a huge effect in our world. And the notion that ESG could really have an impact in many very positive ways in society was appealing to me.
Okay, great. Thank you so much, Barbara Krumsiek.
Thank you.